Believe it or not, my credit history is older than I am. So in this video, I'm gonna share how that is even possible and everything else you need to know to get a perfect credit score. When applying for any type of loan, every lender is gonna look at your credit score. The higher your score is, the more trustworthy you are in the eyes of the lender. The higher score will lower the lender's potential risk, which will encourage them to loan you money with the best possible interest rates and terms available. This will save you hundreds of thousands of dollars in interest over your lifetime. So your score is calculated by 3 credit reporting bureaus: TransUnion, Equifax, and Experian. These organizations collect and organize your credit data in order to generate reports. You have 3 different scores, one from each bureau, but usually they're all around the same ballpark number. When applying for a mortgage, the lender will pull all of them and only take into consideration the middle score out of the 3. When getting other types of loans, lenders will usually pick one of your scores at random and use that. The way each credit bureau scores you is based on just 5 things, with the biggest one being your payment history. Your payment history makes up 35% of your total credit score. The bureau will add up every loan payment you've made on time and then divide it by every payment that has ever been due, giving you a percentage of on-time payments. So if you've only had one credit card and you owned it for 100 months, but you missed 5 payments, you would take 95 because that's the amount of payments that you made on time and divide it by 100 because that's the amount of total payments that you were supposed to make, giving you an on-time payment percentage of 95%. But if you've had 10 loans over the course of your life for a total of 100 months and missed 5 of those payments, you would take 995 divided by 1,000, and that would give you an on-time payment percentage of 99.5. So the more total loan payments you've made, the less missed payments affect you. If you have an on-time payment history of 99% or above, your score shouldn't decrease. Also, if you have had to file bankruptcy in the past 7 to 10 years, depending on what type it was, that will be shown on this portion of your credit report, obviously damaging your score. So this category is simple. As long as you almost never miss a payment on any loan or haven't filed bankruptcy in the last 10 years, then this portion of your credit report will be perfect. The second biggest category is your amounts owed, making up 30% of your credit score. This category takes into consideration these 5 things. But the most important thing you can do to keep this category perfect is to not use more than 9% of your credit utilization. So let's say you add up all your credit card limits and your combined total is $10,000. And say you spend $3,600 a month on those credit cards, even if you pay the balance in full, your credit utilization rate is still 36%. You might think that's pretty good because not even half of the total credit available is being used. But here's a graph showing the ideal utilization rate. If you use 36% of your credit limit, your score could drop 25 to 50 points just from this one thing alone. So you never want to go above 9% of your credit utilization. Even just 10 to 29% could drop your score by 20 points. So instead, with the same situation as before, a $10,000 limit and you spend $3,600 a month, you want to now pay $900 every week on your credit cards. This will keep your credit utilization below 9% and maximize your score. Or over time, you could get more credit cards and increase your credit limit to $40,000. It doesn't matter as long as you don't let your combined balance get above 9% of your combined credit limit. Another way, if you need to boost your score quickly, is if you have an auto or home loan, you could put a big chunk of money towards the balance. This will lower your balance amount compared to the original loan amount, giving your amounts owed category a quick boost. The third component is your credit mix, which makes up 10% of your total score. Credit mix takes into account the different types of loans that you have had. They want to see that you can be responsible with 2 different types of loans: installment accounts and revolving accounts. Installment accounts would be like a mortgage or an auto loan where a certain amount is due every month until the balance is paid in full. Revolving accounts provide you with credit that you only need to pay back once you spend it, like a credit card or home equity line of credit. Now, while both can help your score, you obviously would never want to take out an unnecessary loan just to help your credit score. With this only making up 10% of your score, it will not damage your credit to only have history for one of these loan types. You can still have perfect credit with only one type. Just make sure when you do eventually need to take out a mix of credit types that you pay them on time every month to keep a perfect score. The fourth category is new credit, and that also makes up 10% of your score. Anytime you apply for a new loan, the lender will do a hard inquiry on your credit. This will be factored into your new credit category for 12 months. The best way to keep this category perfect is to not apply for too many new loans or credit within a 12-month period, because the credit bureaus will assume you're in a tough financial situation. Whether true or not, this will be reflected on your score. When in a situation where you are shopping for the best terms, for a mortgage or auto loan, you will want to have each lender pull your credit within a 30 to 45 day window. The credit bureaus will realize that you're loan shopping if you have multiple credit pulls for the same type of loan around the same time. So they will only report it as one single inquiry because they know you are only going to pick one of the lenders and not get a loan from each. And the last category, making up 15% of your score, is credit history. When assessing your credit history, the bureaus look at how long your oldest account has been open, how old your newest account is, and the average age of all your different accounts together. So if you have 2 credit cards and got one 4 years ago and the other one 2 years ago, your average credit history will be 3 years. To maximize this category, you never want to close out old accounts even if you don't use them anymore. Also, make sure you don't take out too much new credit if you don't have any old credit to balance out your average. But the big catch-22 is you often need credit history to be approved for credit in the first place. So the secret to doing that is becoming an authorized user. An authorized user is when someone who has good overall credit adds you to one of their accounts. This is also known as piggybacking credit. Most of the time, this can be done with a parent or an older family member. The person who adds you to their account is known as the primary cardholder. The huge benefit of this is that you inherit everything that has ever happened on that credit card account. So if that card has been open for 30 years, you now have 30 years of credit history. If the primary cardholder has never missed a payment, you now have an on-time payment percentage of 100%. You immediately inherit everything, so you can see how this builds your credit instantly. Another benefit is if you didn't have any credit history at all before becoming an authorized user, the credit card account will send you your own card to use. So you don't have to apply for one on your own. But it won't be necessary to use that card because now that you have credit history, you can be approved for your own card. But be careful because this goes both ways. If the primary cardholder does something wrong, like misses a payment, this will negatively affect your score. And vice versa, if the authorized user does something wrong, the primary cardholder could have their score lowered as well. If you don't have someone who would be willing to add you as an authorized user to one of their accounts, there are companies that you can find online and pay them a fee for this service. They will connect you with someone who has good credit and is willing to add you as an authorized user to one of their accounts. I definitely don't recommend paying a company for this. I would rather try to pay someone who I know and trust to become an authorized user on their card. But I thought it would be an option worth mentioning. Make sure when you do find a potential primary card holder that they talk to their credit company beforehand to ensure that they report authorized user activity to the credit bureaus because some credit cards do not. If you can manage to become an authorized user with an amazing primary card holder, the first credit score you ever receive could be over the 800 mark. So if your goal is a perfect credit score, it's because you want the best loans possible. Click here to learn how to achieve that in real estate. Feel free to comment any questions you have, and if you need help buying, selling, or investing in real estate, my information will be in the description.